We can start now, ma'am. You'll have to unmute yourself.
I'm audible, ma'am?
Yes, ma'am.
Good evening, everyone. We welcome you all in another live session on Introduction to Financial Modeling and Analytics. Prediction is very difficult, especially if it's about the future. In the words of Niels Bohr, with this quote, I would like to introduce our speaker of the day. We have with us Dr. Arnav Kumar. Dr. Kumar is currently assistant professor in the Department of Management Studies at Ramanujan College, University of Delhi. He has done his post-graduation with distinction and doctorate from Department of Commerce, Delhi School of Economics, University of Delhi. Having a rich experience of more than 8 years of teaching postgraduate and undergraduate courses in management and commerce, he specialized in statistics, analytics, research methods, and has teaching and research interest in finance and investment. He is also the managing editor of Ramanujan International Journal of Business and Research, RIJBR, which is listed in UGC Care Group 1. A vivid researcher, he has published 16 research papers in national and international journals of repute, including ABDC listed journals, and has presented research papers in about a dozen national and international conferences and seminars. He has received 9 Best Research Paper, Project, and Presentation Awards at different national and international conferences. He has provided consultancy in major UGC, ICCSR, and DU innovation projects. He has undertaken 36 sessions as a resource person, invited speaker, including in MHRD-sponsored national level FDPs, workshops, 1-month faculty induction programs at institutions such as Shriram College of Commerce, Hindu College of University of Delhi, and also in various B schools. He has conceptualized and conducted specialized diploma and certificate courses on contemporary topics such as financial modeling, business analytics, and research and data analysis. We welcome you, sir. We are privileged that you can find time for us and able to conduct the session. Over to you, Arnav, sir.
Thank you very much, Sonia ma'am, for the kind introduction. My dear colleague Parul ma'am, Aarti ma'am, and Prashant Akil from college. Thank you everyone for providing this platform and hosting. Hope my audio is clear. I would be speaking at this pace.
Yes, sir.
Okay. Thank you, ma'am. And most importantly, welcome to, it's a great joy to see over 150 participants joining for a session, especially after so much time in online. It's a great relief that so many people are still tuning in. That's a great motivator for any faculty and resource person. So today we have a very interesting topic, as this whole program is bringing innovative topics. So in finance area, today we are talking about financial modeling and analytics. So I hope my screen is visible, this PPT screen.
Yes.
And
Yes.
Okay. So before I start, we will, ma'am has already introduced about myself. So I will start the session by giving a brief background. So many of you, I think, are already, must have already been, and ma'am, what is the sequence? I think, are we going to take queries at end, or how should we go about it?
We can start the session at the end. We can take the queries.
Okay. So all of us have taught finance papers, probably due to popular choice of students, due to excess workload. Some of you may be directly very much interested in finance. Others, as part of commerce and management, we have already read finance. So when we talk about finance, we first of all look at financial management or corporate finance, and we have certain, legendary texts, both India and abroad, on that subject. Next broad area in finance that we talk about is financial markets and institutions, in which we give the introduction of different financial capital market, money market, secondary, primary market, and different financial services that are there. Then we also talk about investment management, portfolio management, security analysis. I don't think there is any course anywhere in India of nowadays, even graduation course, which does not have a paper on investment, which does not have a paper on corporate finance, which does not have a paper on financial markets, or at least offer these papers as electives. So we are already quite a bit familiar with these normal courses that are there in finance and that we know as finance. Some of you may be additionally interested and teaching in through teaching or research. Some of you may be also engaged in, for example, I also teach paper on international finance. So there is international finance also. Some of you may be teaching or researching in derivatives area. So there is a whole area within finance of derivatives and risk management through derivatives. There are also many areas like project management, mergers acquisition, corporate analysis and valuation. And all of these are fundamentally related to the main three streams. Nowadays in investment also we are having new areas coming, new topics coming up, new subjects or subdomains coming up. Like in investments we have personal finance, we have wealth management. So these new things are coming up, but today we have taken a rather technical topic, financial modeling and analytics, which is the reflective of more quantitative side of finance. So with this background, I would start by talking about financial modeling, econometrics, analytics. We would also cover their methods. So there are different methods in financial modeling, different methods in econometrics, analytics. Obviously, they themselves require a whole course. So we will be just taking an overview and I will be chartering you through the territory. I will also be telling you what are the applications, because applications is most important. Nowadays, UGC has also mandated that all the programs and academic courses must have learning outcomes. We are teaching learning outcome based curriculums, even in universities. So everywhere there has to be application of what we are teaching. So all these techniques have their applications. Then I will also tell you some of the courses, some of these courses require a lot of prerequisites. So I will also be talking about and experience through having multiple sessions, because students are not so much interested in having learning resources, but faculty members and research scholars are always interested in having learning resources from where they can refer more, from there where they can read and learn more, good references from which you can get. But before that, I would like to share 3 small thoughts with you. One is shared by Albert Einstein, and I thought of sharing this because we are all teachers also. So the thought says, if you cannot explain it simply, you don't understand it well enough. So I introspected on this thought quite a bit, and I found that it is actually true. As teachers, even if we should be able to explain it in simplest form. And this I am particularly telling today because the topics that we are going to cover in this session are topics which normal finance students, normal MBA students, normal MCOM students, normal BCom, BBA, BMS students will like to avoid. Even if they opt for finance, they won't like to go in financial econometrics. They don't like to go in financial modeling. So as teachers, we will have to motivate them and we will have to handhold them. And for that, we will have to explain things simply. Because if we make it complex, then nobody is going to, they are already terrified of these subjects. So we should be able to, imbibe this idea that if we understand it well enough, we should explain it simply. And the other thing I know some of you may be from HR, OB, marketing background, but I would strongly recommend nowadays there is even marketing analytics, there is HR analytics. In fact, I was just going through nowadays so many Indian authors, though I would not be able to recommend you a good book. We have gone through all of them, but I was just scrolling that HR and analytics was considered completely poles apart. It was always assumed for several decades that HR has nothing to do with numbers. And nowadays, there are so many authors, including Indians, who are analytics, people analytics. So I think that even if you are not from finance, I sincerely believe that you should imbibe little bit of understanding. And I'm not saying a lot of mathematical equations or such things, but intuitive understanding of statistics and methods. And if there are some people from marketing HR who would like to know about such good books who can give them non-mathematical introduction to statistics and research methods, towards the end of the session, you can raise your query. I would be happy to share with you readings for that also. So I'm, my message is same as one written here. You're missing excitement of life if you are not using statistics and analytics in today's time. And what is statistics? Statistics is a journey from data to wisdom. And finally, this applies to us also, and this applies to our students also. Thought number 3, that we should be willing to learn. And if we are determined to learn, we should not, there's nothing that can hold us back. So when opportunity comes, please open the door and embrace it. So today is a new opportunity for all of us. And today you may get a complete new insight into few things. So starting with financial modeling, but before I start with financial modeling, I would like to give you a brief overview before I go into slides and all. See, the fields of financial modeling, financial econometrics, and financial analytics. Though the idea initially proposed by the organizing team was to just cover financial modeling, but we have after mutual discussion expanded it to financial modeling and analytics. And now I have put econometrics also in between, because essentially there is no strict borderline between these three things. If you look at a financial econometrics book, they are also doing modeling. They are also covering a little bit of analytics. If you take up a financial modeling book, they are also covering econometrics, little analytics to quite extent. You take up an analytics book, it is covering both. So there is no strict boundary and there is no strict definition. In fact, if you ask me to define these terms, financial modeling, financial econometrics, financial analytics, I would be in a spot, because when I have researched so much, but there is no strict definition. Every author, every person, every institute is defining these terms based on how they see the landscape, how they are using, and in what context they are using. That's how they have defined these 3 areas of quantitative finance. In fact, there is another area, which is the 4th area, which is called quantitative finance, or financial quant finance, or financial mathematics. That is the 4th area. But I have not taken it up because all of that is there. There's nothing in that which is not covered in these 3. So I would tell you that there is a strong interrelationship and a lot of overlap between financial modeling, financial analytics, and financial econometrics. Now, let me tell you how these things, but there obviously must be some kind of separation. So what I can tell you is that financial modeling is being used mostly for Excel-based or spreadsheet-based applications. Spreadsheet-based applications of corporate finance, of investments, of financial planning. We will see. I will show you a complete list and I will tell you how those things work. So financial modeling is more, about spreadsheet applications and developing spreadsheet-based sort of financial models. So what is a financial model? Financial model is basically a system. So for example, you have put in an Excel sheet, you have put a cell, you have put a cell named A, you have a cell named B, and in another cell, you have written A plus B. So whatever value we put in A and B, the third cell gives the sum of the two. So this is a very simple model. This is a very simple model. Obviously, in real life, we are going, if there's time at the end of this session, I can show you one financial model. Otherwise, I will give you references. So what basically we are doing in financial modeling is that we are using the power and interrelationship that spreadsheet allows, like Excel allows, to develop interrelationships, to develop a system. So in that system, for example, if anybody, for example, even in HR for determining the compensation packages, we have all the cells which are highlighted. We have the cells for this much is the basic. We have the cell for this much is the DA, this much is this allowance, that allowance, and the moment salary is entered, and we have all kinds of if and what if formulas. You must have all heard. So for example, if salary is greater than 50,000, then HRA is this much percent. If salary is less than this much, then HRA is this much. Or if this is this much, then that is that much. So basically, it uses Excel and spreadsheet utilities like if, what if, loops, and all these things for logical and financial functions to derive some utility, to provide utility. For example, many of you might be, I don't know how many of you who are still teaching corporate finance are using Excel, but many teachers have started using Excel, maybe not throughout the course, but at the end you take 1 or 2 sessions. So in that you use the Excel and show that how NPV, how IRR, capital budgeting techniques, how cost of capital can be calculated on spreadsheet, because real world data, it is very difficult to calculate manually and the data is huge. So financial modeling is spreadsheet applications. And what we intend to develop in financial modeling are financial models, simple spreadsheet interrelationships, conditions, interrelationships, which help us to execute the financial task. That's why financial modeling has become very popular. Financial modeling has become very popular for students because it is a skill-oriented course, skill-oriented thing. So for getting jobs in companies, banks, investment firms, this kind of analysis helps a lot. And underlying concepts must be there. Without underlying concepts, no analysis can be done. So that is financial modeling. And financial econometrics employs traditional econometric and statistical techniques, like almost quite a few of you, if not almost everyone, but quite a few of you, and especially those from economics background, if someone is here, you must have read econometrics or basic econometrics books. Like one very popular is Gujarati, which is known all over the country. So econometric and statistical techniques like regression, multiple regression, logistic regression, your causality, co-integration, time series econometrics. And these kind of techniques are applied on financial and economic variables in financial econometrics to test their interrelationship, to predict something, to find out if there is an impact of something. Causal relationships, basically. Causal relationships and impact are assessed in the domain of financial econometrics using on relationship between financial and economic variables using statistical and econometric techniques that are well established. Now they are there for 3-4 decades, more than that. So you can see the first edition of Gujarati, I think, was 40 years back. So till then, people had started writing books on econometric techniques. And nowadays we have books which are writing especially on financial econometrics. And why was there a need for financial econometrics if econometrics was already there? I will tell you later. when we go specifically to this topic, because the nature of financial data is slightly different from economic data. That's why a separate subfield has been created, which is called financial econometrics. It is not same as econometrics. There is some differences. And financial analytics has really emerged only recently. Financial analytics involves use of artificial intelligence, computer programming through softwares like R and Python, and automation, and all kinds of things are there. I will tell you about financial analytics in detail, techniques and applications, machine learning, supervised, unsupervised machine learning methods are there, data science techniques are being used. All these programming and artificial intelligence based computer program, software programming techniques are being used to different fields of finance. And we will tell you that how they have improved. There are so many applications. And that's why financial analytics has emerged very recently. Probably the youngest amongst all these is financial analytics. So now, without further ado, let's get started in details about each of them. And for each of them, I will be covering the methods, applications simultaneously. So financial modeling, I have taken 3 different definitions. I will not go through them. You can see it. It's on their screen and you can yourself get a feel of what it is. So different people define it differently. So some people say that exploring what if relationship, some people say doing past analysis of company, some people say financial modeling is about predicting future variables of companies, some say financial modeling, but all of them, what is common in all of them is that they are using spreadsheet applications more or less, and like Excel, and they are trying to analyze the company's financials. So whether it is conducting ratio analysis, whether it is conducting duo-pont analysis, whether it is conducting capital budgeting decision, whether it is investment decisions, for example, you can see this. So in a typical, I will also take you through what is the typical contents in all these. So in financial modeling course or in a financial modeling textbook, you will find these things. So there will be some foundational units or foundational aspects. So in that, basics of spreadsheet like Excel is taught, because you don't assume any familiarity for students. Students may not have seen a computer before when they start enrolling for your course. So you have to teach them first the basics of spreadsheet. Then you teach them finance functions in Excel. You teach them time value of money, which is the principal thing in whole of finance. And then after the basics are covered, we go for applications. So in corporate finance, as I was already talking about, one very important application area that has emerged is forecasting of financial statements. So for example, if we already have 10 years, 20 years data, so what kind of forecasting we can do? So there are several methods. We have the trend forecasting, we have regression-based forecasting, we have a lot of techniques for forecasting financial statements. You can find them, you may have already used them, and you can find them in many applications. You can even develop your own technique, because Excel allows you the power, gives you the power that you can yourself specify a formula for forecasting. And based on that, you can make prediction of the values. So financial statements forecasting is there, cost of capital computation, evaluation of capital budgeting. So I told you we can easily compute NPV, IRR, MIR. For example, all of us know that how difficult it is to teach students in classrooms the computation of IRR, because you have to do all kinds of interpolation. We don't know exact rate at which we will get the 2 rates at which we will have NPV positive, negative. So all these can be easily done through Excel and softwares. Then financial analysis of leasing and hire purchase decisions. So typically a financial services course does involve, or financial markets course does involve topics on leasing, hire purchase decisions, because it is very common for manufacturing entities. But again, we teach them just on the notebook and in the traditional way, but all this can be easily done through Excel and spreadsheets. Then equity valuation and firm valuation. So all of you may be aware, some of you who have taken up the valuation courses. So in equity valuation, we have discounted cash flow valuation. We have discounted cash flow valuation. We have free cash flow to equity valuation models. We have different models for firm valuation. For example, we have cost of capital approach. We have adjusted present value approach. We have different approaches for firm valuation, valuation of equity shares. Then we have discounted cash flow models. We have dividend discount models. So dividend discount models, the value of what will be the value of equity share if same amount of dividend is paid, if if dividend is growing at a constant rate, if dividend is growing at different intervals at different rates. So all these things are there. So all these can be exemplified in Excel. And I'm telling you, students can really land up in a good job if these kind of techniques are taught. And you can also write to me on mail. I have provided my mail in the first slide. I will again show it to you. So since I'm also part of the college, so you can write if you people are also interested in having detailed courses. So we can have short courses, 10 hours, 20 hours, in which we can train you also, so that you can pass on this knowledge to your students. And because already you are teaching the theory things in classroom, but you can teach them, you can learn them, and you can teach them yourself. And then in security analysis, bond valuation is there, bond yields, equity returns, risk adjusted returns for equity shares. Then in portfolio management, how to select securities, how to rank securities and select the best securities to be included in the portfolio. So we have several criteria, several methods to rank them. Then variance covariance metrics, because we want securities which have low correlation, low positive correlation, and preferably a negative correlation. We want those kind of securities in the portfolio. So we need variance covariance metrics, portfolio risk return, estimating betas of securities. And the most important thing which is there is the optimization of portfolios. So for example, we have data of 500 companies, we have data of 200 companies. Even if it takes Sensex now also has Sensex 50 is also there, Nifty is there. So we have 50 companies. So out of these 50 companies, based on the historical data, how can we construct an optimal portfolio? So in classroom, we teach in investment, in portfolio management, we always teach that this is the Markovich model, this is the technique for portfolio optimization. But on the real world data, stock market data, you can give them a project, you can teach them, and you can, this is a very useful, because Excel is very good in optimization and all these kind of situations. Even people who are teaching operations research, like topics like linear programming, transportation, assignment topics, they also use Excel for optimization, optimal solutions. So arriving at, the financial modeling, what it has done is that it has provided skill, it has bridged the gap between theory and practice, and that has really helped students. And in investment, there are several things. For example, there is a we use very simple things for retirement and financial planning. Now financial planning is emerging as a very big area. In fact, I tell my students in finance that like there are doctors and lawyers who are consultants, soon there will be a need of financial consultants. Already there are people, and they will not be required just for filing tax, that anyways educated people are doing themselves. You will need proper financial planners who can assess your financial situation, who can give you financial and wealth management advisory, who can do your retirement planning. And in this aspect, there is going to be a huge market, and there are a lot of certifications also available. For CFA is there, certified financial planning is there. So Excel based applications, like for example, if we are doing financial planning for 20-year period, obviously we go through low and high interest rate cycle. For example, now also you can see that since 2019 or 2019, if we take it, 2019 to 2022, early 2022, we were in low interest rate cycle. And all of you are aware that due to high inflation and revival economic growth, RBI and all central banks are raising interest rate. So now we are again going into a high interest rate cycle, and economy keeps on flipping between low interest rate and high interest rate cycle. So if we are looking at 10, 20, 30, 40-year financial planning, retirement planning, investment planning window, there will be many cycles of low and high interest rates. So there will be many different reinvestment rates. How do we develop a financial model in which we can take into account the effect of differing reinvestment rates? How do we decide how much we should save for retirement? A common person will always ask this kind of a question, that I will need 5 crores at the age of 65. How much should I start investing, saving now? How much should I invest in bulk? How much should I save monthly? Like for a legal case or a medical case, like lawyers and doctors give a personal advice, you have to give a personal customized advice. But what we can use financial model is that we can create an Excel based model in which all these factors are taken into account. And once a model, a structure is created, you can just change values and you can just, you will be able to fill in the values and you will be able to see the results. In fact, I will just show you now only. After this financial modeling topic, I will just show you this example of this financial model and this retirement. Then retirement planning in real and nominal currency. What is real and nominal currency? So real currency is after adjusting for the effect of inflation, and nominal currency is including the effect of inflation. So nominal includes the inflation margin and real excludes the inflation effect. So what I should save in real terms and why I should save in nominal terms, like we have real GDP and nominal GDP. So similarly, real currency and nominal currency. So if you have not removed the effect of inflation, if you have included it, then you should tell what needs to be saved in nominal terms. Then portfolio restructuring is required. We all know that in portfolio management, we have two approaches. We have active portfolio management and we have passive portfolio management. Active portfolio management requires constant monitoring of our portfolio. There are so many securities. Which security has to be dropped? Which security should be included? And it's not just about dropping and including securities. It is also about changing their weightage. For some securities, we want to increase the weightage. For some securities, we have to reduce the weight depending upon market condition. Some securities are high beta stocks. So when the market is going up, you would like to increase the weightage of high beta stocks so that they can yield greater returns compared to the market. The more margin by which market is increasing, you can have more than that return if you include high beta stocks. But if the market is falling, then you need to include low beta stocks, because low beta stocks will be defensive. And some sectors or some industries periodically underperform. So in that case also, you have to drop them or remove them or reduce their weightage. Like if you follow up about the reports and recommendations of good portfolio and investment advisors like Goldman Sachs and Warren Buffett and this and that, they keep on giving you quarterly, monthly updates. If you follow their newsletter or announcements, and they tell that we are going to reduce the weightage of this sector, we are going to downgrade the investments in this sector. So portfolio restructuring can also be easily done through Excel spreadsheet based financial models. And then there is the whole world of derivatives and options. So in option, we know classic, there are two option valuation or option pricing models. One is the binomial model and the other is one given by Black and Scholes, for which they got Nobel Prize. So how to carry out, again, if you teach them the formula in class, it is so tough for students. They don't even want to remember the formula. It's so technical. But we can create a financial model. And now actually, in fact, I will give you a reference. For example, the most prominent book in derivatives, which is by J.C. Hull, John C. Hull, which is about options, futures, and other derivatives. They also say that they started with just textbooks, and now I recently bought their book, and they have developed all kinds of softwares which run completely free of cost. In fact, their software is called Devi Jam or something like that. I'm forgetting the name. You can see on their website. So that is a completely Excel based application. That is an example of financial model that they have created, and it is all automated. You just have to fill in the values and you will get the values of option. What should be the option price? What should be the option premium? If you give the inputs. Option Greeks, we all know, are the factors. Impact of sensitivity, it shows the sensitivity factor, shows the sensitivity of option premium, option price to underlying factors like volatility in the price of underlying asset or the changes in price of underlying asset. So option Greeks. Real options are related with options like abandonment. So for example, we normally only consider whether we are going to select a project or not select a project. What about the option of abandonment? Because it is better to abandon a negative NPV project than to take it up and have less than desired return. So option of abandonment is also applied for capital budgeting problems. So all these you can do in spreadsheet and spreadsheet based models. So before I go to financial econometrics and then to financial analytics, let me just share with you an example of financial model. Yeah, I have got it. I will be just sharing the screen now. So, yeah. So what is a financial model? So I've talked about it in theory. Now I'm showing you in the practice. So basically, like any model, we have inputs and we have output. And between the input and output, we have functions. But that function is entirely Excel based or spreadsheet based. Is my screen visible, this Excel sheet?
Yes, it's visible.
Okay, ma'am. So for example, we have entered these inputs. I will not go into details. We don't have time. We have to cover financial econometrics and analytics also, but I'm just showing you that how this model is. So we have provided these inputs. Then there is two different reinvestment rates. For the first period, it is 6%. And for the second period, it is 25%. And we are expecting the duration of first period to be 10 years. Now, what has analysts done is that they have developed a full-fledged model based on these are all the calculations. And as I'm scrolling through the cells, you can see in every cell there is formula that is giving these outputs. So they have developed a structure. So what formulas you are teaching in classrooms and going beyond that, they have actually developed a product which will be counted as a skill set, which they can market, which they can use in real life. And as they always say that most corporate finance and investment firms are still using Excel. That's because of this, that it has power to develop these models. Now, if I change any value, for example, I change the length of this period from 10 years to 15 years, every calculation will automatically change. All of adjustment has been done. So what I have done is I have developed a financial model, which is what? Which is an interrelationship. All these cells are interconnected through formulas or equations. You can see that equations have been put. You can see that if condition, formula, square, under root, or whatever is the underlying theory. According to that, it has been constructed and done. if I show you another example of retirement planning. So in this, we are taking a simple term that a person is looking to invest in two kind of things, two kind of securities. The traditional two options: fixed income yielding a lower return, say 6%, stocks or mutual funds yielding a return of 25%. These are the tax rate, these are the capital gain rate. Expected inflation over the investment period is this much. We are obviously taking average inflation. Initial balance available with a person is this much, but obviously they will also need to withdraw something for their expenditures. That can be this much. Instead of withdrawal, there can also be contribution. All of that can be taken into account for developing a financial model. And the security horizon is this many years. So based on the detailed calculations, you can arrive at the required numbers. All of this, each cell is interlinked with formula. And we can have separate session or course even on this. In fact, as Sonia ma'am said, I also had a course, and we did a course on behalf of Ramanujan College on financial modeling, in which we did all these things. So this is how it all works. So developing this Excel-based function is highly intellectual, analytical application, which develops skills and which bridges the gap between theory and practice. That's the primary purpose, and is a very useful thing in real life. So that's about financial modeling. Now I will move on to questions. I think, as ma'am said, we will take up at end together. So you may please note down your questions. You can note down your question with yourself or put it in the chat. We will take up in one go. So next is the field of financial econometrics. So as I told you already, financial econometrics is, many of you may already be familiar with. So it is use of traditional statistical and mathematical techniques to problems, and to basically to find out relationship between variables, because econometric modeling has, as you all know, is also related to finding relationship between variables, finding the impact of variable on each other. So we have seen that. And what are they useful for? They are useful for testing theories, determining asset prices, testing hypotheses concerning relationship between variables, forecasting future values of financial variables. And if you see the example of actual researches, these are actual researches or problems that are solved by financial econometrics. So we teach efficient market hypothesis. So testing whether in real world particular financial market is weak form efficient or not, or we even have tests for semi-strong form efficiency. We cannot really reliably test strong form of efficiency, but we have tests and techniques for weak form and semi-strong form of market efficiency, CAPM, APT applicability, volatility of bond returns, the determinants of credit rating agencies, credit ratings given by rating agencies. It is so crucial. Even sovereign ratings and corporate ratings are so crucial. They can really impact the country's financials or the company's financials and their credibility and standing in the market. So what are the determinants of credit ratings that these rating agencies give? Long run relationship modeling, then optimal hedge ratio for spot position in oil, technical trading rules. It has been so long debated that do earnings or dividends have a positive or a negative effect or no effect on stock prices. That can be tested. Similarly, for IPOs, modeling the spot or future markets, how quickly they are reacting. There is news modeling also, forecasting correlation between the returns to stock indices. So we always see that yesterday the markets in the West fell US markets, Europe markets, and we immediately see that the next day Indian markets are also down. So there is a lot of interlinkages. Long back, 7, 8 years back, I published a paper also on this. There is a lot of interlinkages between financial markets of different countries. So testing for that interlinkages you can do based on financial econometrics. But why financial econometrics has emerged as a separate area when there is already econometrics and econometric techniques are already there? Why a separate area of financial econometrics? It has emerged because there are certain special characteristics of financial data which make them different from economic data. So, for example, financial data are available at a much higher frequency, and there is no other person who has gone through, and economic data is available at a much lower frequency. So there is no other person who has suffered probably more on this account than me, because my PhD topic was macroeconomic variables and stock market. So while trying to establish or check for any relationship, I was caught in a big trap. Stock market data is available daily, but GDP data before 2004 or 5 was available annually. And since then it is available quarterly. Imagine trying to find a relationship between something which is available daily, and even intraday data you can get, every second data you can get, or hourly data you can get, and the other thing which is available monthly. And the time I was doing my PhD, there was also not so much popularity of or awareness about high frequency indicators, which is there now. There are a lot of high frequency macroeconomic indicators that people track these days. But then we had the traditional ones only, GDP and industrial production index. So financial data is quite different from economic data. Quantity, because the frequency is high, so the quantity of data is very high. Quality is also usually very good of financial data. So, you have so many experts whenever government or RBI or statistics ministry changes the methodology of calculation of GDP, all kind of comments and even political acquisitions are put. So people start questioning that is the data reliable or not. But in financial data, there is hardly any issue of reliability or measurement error. We can, measure it with great accuracy. So these are good aspects. But the problem with financial data is that there is a lot of noise. So noise is a technical term used in econometrics. But if I tell you in a simple way, just like you are speaking to someone over a call, or you're hearing my session now, if there is any background disturbance at my end or at your end, then you will have noise interfering. So what will happen is that noise will disturb or overshadow or hide the actual communication that I am trying to make with you, actual information that I'm trying to pass on to you. So financial data is affected by a lot of random and irrelevant things, which are very short term and which cannot be accounted for. And all of that is noise. So for example, just because something happened earlier, there used to be a joke that if the finance minister gets ill or the prime minister gets ill, then also stock market go down. What does stock market have to do with the direct temporary health issue of any minister or any policy maker? So there are a lot of random things which, short term, obviously long term it can have an issue, but for short term it's meaningless. Even if India wins the World Cup, as it happened in 2011, there was optimism. What does India's winning World Cup has to do with stock market or any of the companies whose share prices went up? Nothing. It was just a market wave. So noise, there's a lot of noise in financial data, which hides the true underlying patterns and trends. And also financial data, there's assumption that of normality in many traditional statistical and econometric techniques, but almost always financial data does not follow normal distribution, because there is very limited time when the market actually follows or behaves like a normal curve, the returns from market. Mostly it is on one side. So normal curve, the bell shape. So it assumes that most of the values are in middle. But in financial markets, most of the values are either on the lower end or on the higher end, because either the market is going through a bearish phase. So bearish phase meaning most of the returns are on the left side, so highly skewed, or through a bullish phase, meaning most of the returns are on the right side and again heavily skewed. So financial data and returns do not follow normal distribution. So because of these reasons, there are special tools that have been developed for financial econometrics, which are applied. And I hope you are also aware of these three types of data. Before I talk about the econometric methods, I will also briefly talk about these three types of data. So time series data is one where we have single unit of study. Variables can be any number. Please always remember, this is a common misconception among researchers and analysts, that these three segregations are based on number of variables. There is nothing to do with number of variables. Number of variables can be multiple in all these three types of data. But the basis of segregation is provided in the table. The basis of segregation is units of study and what is the time dimension. So if you have a single unit of study meaning the firm, the economy, the market that you are studying. So for example, if you have taken stock prices of one company and you have taken that stock price of that company over 10 years, 20 years, then that is a time series data. But if you have taken many companies at a point of time, like at a particular year, you have taken, for example, for the year 2021-22, you have taken data of 250 companies, 500 companies, BSC 500, NSC 500. So that will be cross-sectional data. So anything which has multiple units of study. Why this is a cross-sectional data? Because we have multiple units, multiple companies, multiple industries, multiple firms, multiple countries, multiple economies. So if this is multiple units, like multiple individuals in research, why is the marketing and HR OB data mostly cross-sectional? Because we are taking survey from multiple individuals. So that is studying multiple units. So whenever you have multiple units of study, it will be cross-sectional if we are studying them at a single point of time. But if we are studying multiple units over time, then it becomes what we call panel. And in panel also, there can be two kinds of panel, long panel and short panel. For example, I did a study on BRICS nations stock markets. So we have 5 countries in BRICS: Brazil, Russia, India, China, and South Africa. 5 countries, so there are 5 units of study. And their data I took over a 20-year window. So my time dimension is very large and my cross-section is very small. There are only 5 cross-sections, 5 units in cross-section, while my time dimension, I took monthly data, so 20 years, meaning 20 years into 12, 240 observations. So 5 cross-sections, but 240 time dimension observations. So this we will call long panel. Long panel because it is stretched over time. And what is a short panel? Short panel is, for example, you have taken 500 companies over 5-year period. So 500 companies over 5 years. So there are the units of cross section are 500, but the time dimension is just 5. If you have taken annual data, for example, so 500 cross section, 500 companies versus just 5 annual values of variables. So time dimension is very less and the cross-sectional dimension is very large. So we call it short panel. So panel data is also becoming popular because there are a lot of companies and variables for which we now have huge data set available. So to test relationships, we develop a financial econometric model. So there should be an underlying theory. Then you develop a model, you collect data, and you estimate the model. You estimate the model. For example, we estimate regression using least square method, or maximum likelihood method is also used. There is GMM method also. And if the model meets all the assumptions and goodness of fit parameters, then we go on to interpret it and use it for analysis. For example, a regression equation you can use for predicting. For example, RBI. RBI is using econometric model to estimate or anticipate what is going to be the inflation in the coming months, in the coming quarter. And based on that econometric modeling, obviously also subjective inputs are there, but that econometric model, econometric forecast of inflation plays a very important role in their monetary policy decision. And if the model does not meet its assumptions or does not meet goodness of fit parameters, then we reformulate the model. So this is the standard process of using a financial econometric technique. And this is a summary, a brief summary of different techniques. This is not an exhaustive technique. Particularly, I have left out the measures related to volatility, but I have taken into account other measures. So for example, if we have to see the contemporaneous short-run relationship, then we use correlation analysis. If we have to use if we want to see the causal relationship in the short run, then we use regression. If we want to see the causal relationship between using lagged values, not using the contemporary values, but using the lagged values. For example, you are taking the present values of money supply, and you are using past values of say interest rate, or you're using the current values of GDP, but you are using past values of foreign investment. So if you are using the lagged values of independent variables, then we need to use causality techniques like Granger causality. And there is also a very unique technique, which is impulse response. For example, if you want to see the impact of shocks. So for example, due to the Ukraine-Russia war and the unfortunate loss of lives and tragedy that is unfolding, oil prices have gone over the top, over the roof. So there is a shock in oil prices. Now, due to this shock, there is an impact on inflation. There will be an impact on stock market. There will be an impact on interest rates, because central banks will raise interest rates to control inflation. And there will be a dampening effect on demand and on economic activity. So if we want to measure or quantify what will be the impact of shocks in certain independent variables on the dependent variable, then we use what is called the impulse response function. Then we have the function called variance decomposition. So variance decomposition function breaks down stuff. So ultimately what we are trying to do, all our variables are random. We don't know how they are going to change. So we are trying to study how they vary. So for example, we are trying to study how the stock prices move and in which direction they will move. So basically we are trying to study the variance. So in variance decomposition, we analyze and break down the total variance of dependent variable. We break down the total variance of dependent variable. Total variance is 100%, and we break it down. How much proportion is caused due to the in variable itself, past values of the variable itself, and how much of the variation in the dependent variable can be attributed to the variation in other independent variables. So that is the decomposition of the thing. So one participant is writing that it is very useful but difficult to grasp in one session. I completely agree with you. Even if it would have been a new thing for me and I would have been at your end, same thing would have happened. It's too much, but we have to, that's why I'm giving you an overview, and you will have the recording with you, and we can have separate sessions if you want later on, but you can go through the recording later on at a slower pace and time and again, so you will get and you can note down these things. Then there is the concept of long run in there's a concept of long run in financial econometrics. So long run means that you are seeing the values in non-stationary terms. So for short run analysis, we take the return series or the stationary series. I'm assuming you know what is the concept of stationarity. So we are taking stationary series for short run analysis. Like for instead of GDP values, we are taking GDP growth rate. Instead of stock prices, we are taking stock returns for short run analysis. But for long run analysis, we take their actual values without any stationarity, without any converting them into return series. So if we test the association between actual values without taking their difference or return series, then we will be able to find their long run relationship. So co-integration tells us the long run equilibrium relationship between variables, that in the long run, how they will move. That has great, impact and great effect. Co-integrating regression again tells us, since it is a regression, so it tells us the cause and effect relationship. But since it is a co-integrating regression, it tells us the long run cause and effect. Some of you may also be aware of error correction model, vector error correction model. So if there is a co-integration, we also see that how much is going to be the error, how quickly is the error going to correct it. So for example, many of you, I assume, are married. So in married life, I'm not married yet, but I have seen and learned that in married life, we always have fights, and for some time there is difference and there is fight, and husband and wife are not on good terms. But the strength of relationship is not that how frequently you fight. They say the strength of relationship is how quickly you can reconcile after fighting. So similarly, the error correction model which is used tells us that if two variables are co-integrated, that means they are going to move together in the long run. How quickly they can come back to each other, how quickly they can rejoin on the path of their equilibrium relationship, or how quickly they can come back to their association, even if there is a deviation. There can be deviation in variables due to external factors. There are a lot of other variables, but how quickly can they come back to their original relationship? And this original relationship is captured through a co-integrating equation. Obviously, since these techniques are statistical in nature, obviously whatever relationship is there will be captured through some mathematical equation. So the equation is called co-integrating equation. So error correction model is there, which tells us how quickly the differences will get overshadowed and they will come back to their original relationship. Then there is a auto-regressive distributed lag model. So auto-regressive distributed lag means that you're regressing the variable on their own lagged values. Auto meaning own values, like autocorrelation. Autocorrelation means correlation with self. So auto regression means regression on their own lagged values. And distributed lag. So lag of other independent variables also. So in ARDL model, we not only take the lag of, just a second, I think I have to plug in my charger. Just a second. Yeah. So autoregressive distributed lag means that you are regressing on the lagged values of the dependent variable as well as on the lagged values of the independent variables. So it is a very comprehensive model, tells both contemporaneous and causal, short run, long run, all kinds of relationships you can capture through ARDL model. So all these techniques are there, and since the session is brief, I have just given you the intuitive understanding of what they are trying to do. Obviously, there is a lot of mathematics, a lot of calculation, a lot of software through behind all these things. Okay, and now we are moving ahead and we are coming to the most awaited part probably, because some of you might already be aware of these things. So we are talking now about the third and major component, which is financial analytics. So as I hinted to you in the beginning, financial analytics is about using artificial. So there was one query I just saw in the chat. It is popping up on my screen. So someone asked, what is the use of artificial intelligence? So we are coming to it. This is, you please pay attention. So financial analytics involves the use of artificial intelligence techniques, computer algorithms to financial applications. And again, I have picked up a standard definition. You can see financial analytics involves applying statistical models and algorithms, computerized algorithms to financial market and investment. But again, it is not limited, as I will tell you in the applications, it is not just limited to market and investment data. You can apply it on a range of financial problems. And every day, as we are talking and as we are going through this session, as you are going through this 2 weeks refresher course, every day new and new application and new greater and greater integration of financial methods, financial analysis with these computer programs, algorithms, artificial intelligence. Every day someone in some part of the world is creating an application, is contributing to this body of knowledge. So it is young, but it is growing at a fast pace. But before financial analytics, you need to be good in few things. First, you need to be very good in your subject matter, which in this case is finance. And you need to have good knowledge of statistics and mathematics, unless you find a teacher like me who can teach you statistics or mathematics in relationships and these ways. Most teachers would teach you in terms of complex mathematics and statistics. So you need to be good at, and unfortunately there is also a lack of very good books which adopt a non-mathematical approach to these things, because there is a lot of background. There's background needed of statistics. In financial statistics, you need to know. In mathematics, you need to know linear algebra, you need to know calculus, you need to know the derivatives and differentiation integration. All these things you need to know before you go into this. But there are some non-technical texts also that are coming up, and you need to also know coding, because as you know, all are behind. Just like whatever you see on the stock market, it is going up, it is coming down. What you actually see as happening on the stock market, the truth behind it is that there are people who are buying and selling those stocks. Similarly, whatever computer-based applications you see, there is, especially the softwares, there is some programming, some coding behind that. So you need to know basic coding that can be done through softwares like programming languages like R and Python. If you have further queries, we will talk about it. But these are the prerequisites that you need to know. And these things you need to know so that you don't fall into the GIGO trap. GIGO trap means garbage in, garbage out trap. So, for example, someone ran a regression that how many husbands should have, and they developed an econometric model. And the model predicted that for a particular woman, the model predicted that she should have 4.5 husbands in her lifetime. So obviously, it is complete no nonsense. It has no utility. So softwares don't understand whether they are predicting stock price or GDP or number of husbands or number of children. Softwares, programs, they don't understand what you are feeding them. All they see is numbers coming in and they produce some results. So if you give them garbage, they will give you back garbage as output. So we have to apply our sense to whatever we are doing through programs. So I will first take you, before talking about financial analytics applications, I will take you through certain terms which are very popular. For example, one term which is very popular is machine learning. So basically, machine learning is the ability, just like, for example, derivatives is a contract. So machine learning is basically an algorithm. Algorithm meaning, again, set of commands. Algorithm is a set of commands that you create for performing a certain task. So machine learning is a set of algorithm, but with a capability to learn and improve. So it is clear in the name. It says machine learning. So it is not a dumb algorithm. It is not like typical traditional statistical techniques that no matter how much data you feed or whatever you do, they will every time give you the same result. So there will be no reduction in error. In machine learning, if you provide them the data initially, which is called the training data, they will learn from the training data. And just like you teach students and they learn from you in the classroom and then they appear for examinations, similarly, machine and learning learns from the training data like classroom education. Then they give examination on validation data or test data. And again, the mistakes that happen during the exam, they learn from it and they improve. So for example, machine learning is used commonly to predict, say, default probability. So if machine learning algorithm develops a rule that any person who is above 40 years and is not working and has an educational qualification less than this has a very high probability of defaulting. Now you feed this machine learning data of some 40 plus entrepreneurs. Obviously, those entrepreneurs are not defaulting, at least if their business is doing good. So machine learning will understand that such kind of rule will not work. What will happen in regression? Regression will keep putting every 40-year plus person who is not educated, who has less education and who does not have a job, they will every time keep giving them the probability that this person is going to default on any loan. But machine learning will learn that this rule needs to be relaxed in certain cases. It will adopt itself to the data. It will learn from the data. And what will be the outcome? The outcome will be that the next time predictions are much more improved. That's why machine learning techniques have become so popular today, because these machine learning techniques have such high accuracy, because they are reflecting back on the mistakes which no other software and no other typical statistical technique was doing. And machine learning has three major classifications: supervised, unsupervised, and reinforcement. So supervised is when you are supervised machine learning techniques are those techniques using which you are trying to predict something. And within supervised also, we have two classification, which I have just avoided here because it would have become very lengthy. So there is classification of regression and classification. So if you are predicting a numeric variable, then we call it regression. And if you are predicting a categorical variable, like a customer will default or not, then we have classification. So in supervised machine learning, we are trying to predict, and in unsupervised, we are just trying to group them in cluster. So for example, you have the cluster analysis is a very popular unsupervised machine learning technique. And reinforcement is for certain applications. And then we also should look at these three terms interrelatedly. So we have artificial intelligence, we have machine learning, and we have deep learning. So artificial intelligence is all those endeavors where something which used to earlier require human intelligence, you have developed a program, you have developed a code that can learn and adopt. A very good example I heard several years ago, that world's smartest chatbot had defeated the chess champion at that time. So you all know that chess is an intellectual game. Chess cannot be played through any standardized way. It is not a mechanical task which is automated. It requires intelligence. And several years ago, the best human mind in the probably the best game of strategy was defeated by the artificial intelligence based computer. So artificial intelligence is all those areas, arenas, applications. We have seen so many things. There is a huge number of utilities in healthcare, education. You can Google it and you will find AI applications, Internet of Things, all that is there. Within artificial intelligence, we have machine learning, because wherever learning is involved, it is a subdomain of intelligence. And within machine learning, we have deep learning. Deep learning is for complex tasks. So for example, you see the example of, so I will give you an example of deep learning. So that will automatically include the example of both machine learning and artificial intelligence, because deep learning is a subpart of both. So for example, you have seen face recognition softwares nowadays are being used all across the world, or fingerprint recognition. Fingerprint recognition is still very easy compared to face recognition or compared to voice recognition. These things are very tough. But just like we here, we have a natural intelligence. So we see person, the image goes through our eyes, it goes to our mind, and we process and we recognize that this person is this. But how does programming language do, which does not have a mind of its own? So they do it through deep learning. Voice, we hear some voice, we recognize that it is this person. But how does the software do it? How does all the predictions are going on? You click on one link on Google, you click on one movie on Netflix, you click on one item on Amazon, and you will find several likely recommendations. So all of that is happening based on machine learning. And data science is actually a merger of three fields. So you have mathematics and statistics, which provides the techniques. You have computer science and IT, which provides the software and programs. And you have the domain knowledge from business. That's why data science is the hottest job, and it is the most rewarding career in 21st century. Because mathematics and statistics or computer science or business in isolation cannot be so much rewarding, but all three have come together in data science. That's why it has become so much rewarding. And it has many aspects: statistical modeling, research, applications, and methods. Then there's also a concept of big data. And now, for example, I was talking about stock market data, that there's huge quantity of data involved. So stock market, especially intraday data, is an example of big data. Or imagine a big mall where there are hundreds of customers who are shopping every day. So that data point is a big data. Data collected from there is big data. And big data has 4 characteristics, 4 V's. If these 4 V's are present, then we call that data big. So first, obviously, name says big, so there should be large amount of data. So volume should be there. Velocity, the speed at which data is generating, that should also be very fast, or the time gap should be very low. So for example, a very busy mall, data from a very busy mall will fall into big data. Intraday stock market data will fall into the category of big data. And there should also be variety. So for example, in stock market data also you have opening, closing, and all that. If you use credit card, so we get so much information about customer. We get their bank account, we get the type of customer, their gender, and all that. If you log in through Google or something on any social media, there your name, your gender, your date of birth, and hence your age, your nationality, at least 4 or 5 information goes to them, because you have used that information to create a Gmail account. So all of that is passed to wherever you log in through your Gmail account. So there is a variety of data. And veracity, that is generation by a systematic process, organic process or a systematic process, like people coming into the store or logging onto a popular platform. And data mining is a technique, just like in mining, we don't know. Nowadays there is a lot of technology involved, but earlier we didn't used to know what we'll find. So you may mine and you will simply find useless rocks, or you may find coal, or you may find oil, or you may find gold, God knows what. So data mining is also in that context, that you dig deep into the data and try to apply techniques to get relevant information, and you don't know what will come out. So many times a data mining exercise can be fruitless, but on other times it may give you a great, insight or great utility. Then there's also a concept of business intelligence, which is mostly reported to data visualization. So you use charts, tables, and nowadays what we use dashboards. So dashboards, for example, on a dashboard, even in fact in financial modeling also we teach these creation of dashboards, because Excel also facilitates creation of dashboards. Nowadays there is also other softwares like Tableau and Power BI, which helps in creating these dashboards, which can allow us to track things on real-time basis. And business analytics is use of all these techniques and programming for business utility. And we basically have 3 types of analytics: descriptive, predictive, and prescriptive. So descriptive is when you explain what has happened. So like you explain the sample using descriptive statistics and graphs. So that is part of descriptive analytics. Predicting obviously is predicting the future. So predicting future sales, predicting future revenue, predicting future default, predicting future stock prices, asset returns, all of that will be predictive analytics. And prescriptive analytics is recommending the best course of action. Prescription, like doctors give us prescription, which is for our best health. So in prescriptive analytics, we try to recommend the best alternative for a given objective. So prescriptive analytics is mostly used in operations research, like what should be the optimal transportation or assignment solution. That there we have a lot of uses. So you can see tax evasion, credit scoring, a lot of examples of predictive analytics. And in financial analytics, so with all this background, I think now it would be clear to you what is financial analytics. So financial analytics is use of data, information technology, statistical and quantitative methods for use by investors, market practitioners, and managers in their business situations. So there are a lot of applications of financial analytics, and we are coming to the end of discussion. So one is financial feature engineering. So in computer science language, variables are also known as features. So what you call variables are also called as features. And engineering means obviously to create something new. So creating a new variable using existing variables, that will depend on the situation, what you require. So for example, I will give you a very good example, a very simple example, that instead of taking money supply in absolute terms, we take money supply as a proportion of GDP. So we are creating a new variable. We have the data of GDP, we have the data of money supply. We are taking money supply as a proportion of GDP. So this is creating a new variable. Or we take log transformations, that is creating new variable. Sentiment analysis. Sentiment analysis involves lot of analysis of lot of, for example, videos, textual data, audio data, posts on social media, and you also have a lot of centimeters, sentiment indicators on. If you go, for example, on sites like moneycontrol.com, they keep asking you for this share value whether you will like to buy, sell, or hold. But sentiment analysis is beyond that. It is going through, it is an intelligent application. It is an intelligent application that itself goes through all the information and the news that is coming up relating to a particular stock and indicates to the user that there is a positive sentiment about this stock. So if the sentiment in analysis indicates positive attitude, positive perception about the stock, you may consider buying it. And if there is a negative sentiment, you should consider selling it if you have already purchased. Algorithmic trading. So algorithm, again, I told you, are set of computer codes which are designed to perform certain tasks. So algorithmic trading is that you give set of instructions that, for example, if the stock price falls below this, and this is that, and that is that, then buy this many shares. So the computer will automatically execute your trade command. And so you don't have to keep tracking it, because changes sometimes are so fast that you cannot track and you have to spend all lot of time. So better than that, you can create a trading rule or a trading command that if this price touches this, or if this condition is met, then you purchase this asset. Or if the price falls below this, or if the prices rises above this, then sell it and book profits. Then obviously asset price prediction, because there are a lot of techniques for predicting the returns and prices of assets. Portfolio evaluation and management, including restructuring. Investment advisory has been a long-standing practice. There are also nowadays robo-advisors. So basically robot who advise. So a lot of things are getting automated. So robot advisors are non-human advisors. So the work they are doing is same, investment advising. But instead of human, you have an artificial intelligence-based system, which is giving the recommendation after going through all the data and information that is available. Just like a human, again, you understand what is artificial intelligence. Just like after going through all the news and data, a human mind would process it and would give you an advisory. Similarly, a computer program will give you an advice, that is robo-advisory. Then chatbots are becoming very popular. So for example, if you go to many sites of private hospitals or private educational institutions, MBA colleges, all of them have chatbots, but not all of them have chatbots, sorry. They have what is called online chatting. So someone is online, another human being with whom you are chatting. But chatbot is that on the other side, you don't have. So for example, I was using Zomato and there also I found that nowadays they are using chatbot instead of a human on the other end. It's obviously saves on labor costs. So banks and financial institutions are using chatbots assistant for a lot of common queries. So someone comes and asks, what is the rate of FD? Or how to open a saving bank account? Or where should I go for taking a loan? So all these things can be answered by a chatbot. So chatbot is entirely developed from computer program and is an intelligent. They understand your question and try to give the most appropriate answer, just like what a human being does. They understand what you are asking and they give a reply. Then text analytics for qualitative data. So for example, in financial analysis, we go through the financial statements, but there's huge treasure of information that is there in annual reports, in director's report, in chairman's speech. So who will analyze that? Now, either you can spend hours and hours and days reading every line, or you can develop a computer program through text analytics, which will tell you based on the report that what is the recommendation. Then again, derivatives, pricing and analytics. Obviously, derivatives is almost entirely is too complex to do manually. So those who know derivatives know it. So there are programs for it, and also for option trading strategies, implementing option trading strategies. Interest rate analytics, particularly predicting interest rates, again through machine learning techniques. Risk modeling and analytics, how to predicting risk, how to diversify risk, manage risk, all of that is there. Fraud detection. Now there are millions of transactions. Like for example, there are millions of credit card transactions that are happening world over. How does bank know that particular transaction is fraudulent? So they develop a set of code and programs which is intelligent enough to detect any suspicious activity. And for example, what is suspicious activity? For example, if you might be getting this even on your Gmail account. For example, if your Gmail account is logged in from a new phone, or someone is trying repeatedly to log in using different passwords, they consider it suspicious. And even if it is you who is logging through a new system, or even if it is you who have forgotten the password and are trying many times, they will classify you as suspicious and they will immediately send you a mail or notification. So fraud detection is by finding out unusual transactions and then classifying them as potentially fraudulent, which is then further taken up for scrutiny. And similarly, loan, credit card, and insurance underwriting. So which person is going to default? Which company has a higher probability of defaulting? And based on their default probability, for example, in insurance business, what should be the premium that we should charge? Or in the loans business, what should be the rate of interest which we should charge? So for big accounts, it is possible that, banks can assign a person. But for a large insurance company or a large commercial bank, to do it for individuals is very difficult. So they are developing algorithms, artificial intelligence based programs that are doing it. Tax compliance. GST collection of India has reached a record high of 1,57,000 crore in the month of April. At one time, we were wondering if we would ever pass 1 lakh crore per month. Now it has gone to 1,57,000 crore. And one very big reason is that we have improved tax compliance. And tax compliance has been improved using analytics by finding out which people are evading taxes. Even you can find even government revenue secretary and all of them praising these AI-based techniques for their improvement. And similarly, you can detect money laundering if there is an illegal transfer. And in trade settlement also. So you would say, why trade settlement? So what is trade settlement? Buyer gets the securities, seller gets the money. That is trade settlement. But trades still, you would be shocked to know that in some cases, up to 30% of transactions get stuck. They do not get settled automatically. So analytics and computer programs delve into what is the reason. They analyze it and they recommend solutions so that those transactions get settled. And a human being will take several minutes up to several hours to solve a stuck trade or settlement. But a computer program can do it in a few minutes, few seconds. And the big one, blockchain, cryptocurrencies, and fintech. All of you are aware of it and you must have heard about it. In fact, the certificates that you are going to get from our program are also coded by blockchain. So even if though they are digital, they are not capable of being duplicated. So security is ensured through blockchain. Cryptocurrencies is entirely running on mathematical algorithms, and the fintech industry is entirely a product of use of information technology in the field of finance. So all your mobile banking and payment softwares and UPI, everything is running through computer programs. So these are the applications, and these are some good references for financial modeling, for financial econometrics. I have given the details of all the textbooks for starting with R and Python, business analytics and machine learning if you want. Finance foundations, because for financial econometrics, in fact, for all three, even for financial modeling. So I would have, sorry, but I have not given any Indian authors. You should read standard foreign authors who are legendary in their fields. So for corporate finance, Briley and Myers, investment, Bodie, Marcus, Kane, options, futures, there's only one name of JCL, fixed income securities. And then if you are good in all these, you have good command over finance, you have good command over statistical and machine learning methods, you have good command over R and Python, then you can go and start reading some introductory texts on financial analytics, which will explore and give you example of some of the applications that we have discussed. So that's it from my side. Thank you so much. And don't worry, the links are there, the details are there in the PPT, so it will get shared. Over to you, Sonia.
Thank you so much, sir, for such an interesting and informative session. हमने बिल्कुल start basics to advanced level देख लिया है इस चीज का, and we have time for some queries from our participants. So first question by Kirupandan, person is asking, what are the direct and the indirect benefits of financial modeling?
Okay, what are the
direct and the indirect benefits of financial modeling?
Okay. So, sir, I think you must have seen the varied number of applications. So applications, see, any model is created to simplify human effort. Human efforts which are going to repetitive activities, which are low yielding, are automated in a way when you create a model for it, and it provides you flexibility. So I gave you a lot of examples, applications in corporate finance, in investments, all of that is facilitated through financial models. And that is, and remember, financial model has not come from academia, financial model has come from the industry. So rest assured that it is highly useful.
The next question is, what is the difference between NPV and ARR?
NPV and ARR, okay. So NPV is net present value, and it is a discounted cash flow technique. We basically calculate the present value of all cash inflows and subtract present value of all cash outflows. And ARR is accounting rate of return, also called average rate of return. And it is it is a technique which does not consider time value of money and hence redundant. It is also based on accounting data, while NPV is based on cash flows. And for greater insights, you can refer to any standard introductory text on financial management. It will have other techniques also. These are techniques of capital budgeting.
Thank you, sir. Next question by Dr. Surjit Kumar. He's asking, do we have any courses and softwares to learn financial modeling or financial engineering?
See, for financial modeling in the PPT itself, I have shared books. There are many courses on financial modeling going online. You can explore them, but I cannot really vouch for their reliability, particularly those which do not involve live session. They have just posted videos and people are going through it. We as an institute have done a course on financial modeling, and we plan to do it probably in the second half or early half of next year. So you can stay in touch, and we will definitely communicate through the same channels through which you got to know about this program. That's what I can tell. And there are some good books on financial engineering also, but be sure that for financial engineering, you will need good amount of mathematics and knowledge of derivatives, because it is a further step ahead of that.
Thank you, sir. Next question by Pooja Goyal is, can you suggest any good software for meeting the goals of financial analytics?
R and Python. And if you want to choose one, Python. You should learn Python.
Thank you, sir. I think we have covered all the questions.
Yeah, I was expecting a lot of questions of crisp replies. Yes, ma'am. I think all questions are covered.
Yes.
Okay.
Sir, on behalf of organizing team, I would like to present a formal vote of thanks to you. I would like to extend my warm thanks to you for such an interesting and informative session on introduction to financial modeling, financial econometrics, and financial analytics. You rightly bridged the gap between theory and the difference between theory and the practical concepts of finance. We would like to have more sessions with you, sir. Thank you once again for this interesting session. And thank you to all the participants and organizing members for joining us today. Thank you, everyone.
Thank you, Sonia, ma'am. Thank you to participants and organizing faculty. Yes, thank you. Ma'am, I think there was one query about PPT, the email ID. So I think that is there in the PPT. So it will get passed on to them.
Yes, sir, we can share it.